Hello, I'm Robert, and welcome to my channel, where I talk about everything automated algorithmic trading, or simply algo trading. If you've been following my videos, then you know I've been talking about the research I've been doing over the last 2 years. And that is going to be what this video is about. Except today, I'm going to be talking about the Forex market, whereas the last video I talked about the cryptocurrency market. Now, particularly for this case study, I'm going to be using the USD JPY pair, as it is very fascinating and led to some interesting results that I thought were too good to be true, and I really wanted to test it. So let's get straight into the goodies of this video. I'm on the private repository, and you can gain access to this repository simply by sponsoring the Jackrabbit relay. You can click on the sponsor button and then click on the sponsor button here, and it will take you to the page to sponsor. You can pick a tier you feel most comfortable with, and it will give you instant access to this repository. If you're a Patreon subscriber, you already have access to it if you've given me your GitHub username. So let's get straight into the research for USD JPY. This pair really is fascinating. So let's get right down to the summary and overview reports. So here's the overview report, and we can see that the 5-second time frame profited $141. It did 6 trades, and the optimum take profit and stop loss was 5 pips versus 35 pips. Now remember, when you look at your different time frames, it is important to extrapolate, tongue-tied there, each time frame to the next, so that you can see that as you increase in the duration, the profit potential also increases. You can also see how the winning versus losing trades begin to grow and affect the trading process within respect to the time frame in question. Now, when you're looking at this particular time frame table, you see that the vast majority of trading occurs between 30 to 60 pips. So that was my test basis for the duration. I actually started out at 35 pips, but then in seeing and watching the trades, I moved to 60 pips for my stop loss. And I'll actually show that process a little later. But for now, let's actually look at the table to get an assessment. Now, the program that I wrote works roughly around 10 seconds, so I'll use the S10 time frame as a reference point for this next discussionary part. So here we are, the summary report for the 10-second time frame. Now, all trades start with a $1,000 balance, and I use only 2% of that balance for my position sizes. That's critical to remember. That basically means every single function within this trade starts at $20 only. That is all I actually ever have in the market in the very beginning of it, and then I compound upwards throughout the trading cycle. So let's get down to the actual table itself, where you see organized the maximum profit. And then the table goes down based upon profit, where I then count the number of trades versus the number of losses. The number of winning trades versus the number of losing trades, the take profit and stop loss. The emphasis here is to find the best take profit and stop loss that produces the best profitability. And we can see from this analysis, and this is testing 5 pips to 30 pips for a take profit against a stop loss of 5 pips to 500 pips. I run every single process to determine the best in this table. And all of that data is available here on this repository, which we will talk about more as well. So we see this short-term table. 379, 5 pips, 60 pips. That's not bad. That's really nice. Now, as you look at this table, there is something critical you must understand, and it goes against the very nature of what everybody is taught in the market. Reward to risk ratios are always spoken of as 2 to 1 or 3 to 1 or 1.5 to 1. But what this table shows is profitability is actually with the take profit or the reward less than the stop loss. And there is a statistical reason for that. When you're looking at the market, in this case, 5 pips take profit, 60 pips stop loss. You're looking at a reward to risk ratio of 1 to 12. That is, 1 stop loss will take out 12 winning trades. That's upside down. But statistically, you are 12 times more likely to hit a take profit of 5 pips than you are a stop loss. So when you look at the statistics, it makes perfect sense why you want your take profit less than your stop loss. If you have a stop loss take profit of 2 to 1, meaning you win 2 trades for every losing trade, then you are statistically more likely to lose than you are to win. That is, you're going to lose 2 trades for every 1 winning trade. So as you look at these numbers, you will see clearly that your take profit must be lower than your stop loss in order to truly be profitable. How much lower is the point of this analysis and these case studies, to actually see just how different levels affect profitability and how they affect the number of trades in general for a given time frame. And in every case, the same 5,000 candles were used for the evaluation to ensure a pure apples-to-apples comparison between each take profit and stop loss, so that the results could be repeated and repeatable consistently. It also made sure that the data itself was verifiable throughout the entire process. And as you can see, we could even get down to cases like a 50 pip take profit versus a 40 pip stop loss. Let's see, that looks like it's the first one that showed any real profits. Okay, no, up here, 30 pip take profit to 20 pip stop loss. That's roughly a 1.5 to 1 ratio. It made $265, but it won 4 trades and lost 3 trades. When you're trading, you want to maximize the number of winning trades with the lowest number of losing trades. That is what defines your trade sustainability over markets. Because the one thing to remember, the market is going to change, with or without you. So it's a matter of whether or not you have a framework or a strategy that will change with the market, or can weather the market as it changes. And that's really what this table is about. It isn't just picking the winning combination and going to town. It's about looking at your risk versus your reward in a way and in a context appropriate to your trading and your own risk assessment. You may still prefer a 2-to-1 reward to risk ratio, or you may prefer a 1-to-12 reward to risk ratio, depending upon how you feel is appropriate for your own personal trading. The data here represents an unbiased representation of what trading is, and you pick what you feel most comfortable with through analyzing the data and actually looking at the candlestick trades as they take place. So as you can see, we actually go down quite well, and you get a very clear consensus of exactly how the market looks at different levels. And that really is the point of the process, to give you a clear representation of your own trading and how to actually profit from trading in a meaningful way. And you can see the profitability drops quite drastically as the ratios change between stop loss and take profit. And you can even see at the very bottom of the table losing trades, and again their corresponding take profit stop loss. So now that we've established a base point and we have some very good numbers to look at, after all, you're dealing with the 10-second time frame. Who wouldn't want to make $200 to $300 every day and a half or so? That's really wonderful stuff. So let's get into the next part of it and actually take a look at the individual trades and see just how that affects a time frame in reference to the volatility and profitability projected here. Okay, I'm in the private repository where we can actually see the individual trades, the part that you would download to look at once you're subscribed. Now, we saw from the previous table that the best take profit and stop loss was a 5 pip versus 30 pip. So let's go to the actual raw data and see how that looked in trading. So we have it here, and we have some very important things we need to cover here. Forex is typically margined or leveraged, so there's a lot of things we need to unpack in this report to really get the meaning of it. Remember that my initial balance is $1,000, and my position size is 2% of that $1,000, or $20. Now here it says that my starting unit size is 400. Well, my leverage is 20 to 1. So 20 times 20 is 400. Now, if I was to trade this unleveraged, that means my position would be $400, or 40% of my balance. And that is an insane risk level versus 2%. So my actual buying power is $20,000 with leverage versus the initial $1,000 budget. This is critical because if you don't really pay attention to the details here, then a lot of what you're going to see is going to be manipulated. And this is why I don't edit my videos. Because as you can see, 400 units. This particular trade made a take profit, and it says I made $26 of profit. That sounds and looks wonderful. But if I didn't put the truth in that this is a leveraged account, you would actually think I made $26. So think about that. My original position is $20. How can I make $26? I can't. But that's the kind of deception that goes on throughout the market that isn't talked about enough. This is why I don't edit, and this is why I make sure that the numbers are clearly represented. What you have to do is take this number and divide by 20, because your margin is 20 to 1. So are you looking at roughly $1.80 some odd cents actual profit for this trade? That is what you will get in your account. I could deleverage the profit and loss, but I don't, because I want you to realize and see the level of risk. For example, if we look right here, stop loss, $175. You're looking at literally 6 successful trades gone right then and there. That is the downside to having a reward to risk ratio below 1 to 1. And as you can see right here, it's 0.17 to 1. But my win to loss ratio is 8.5 to 1. That is, for every losing trade I take, I win 8 trades. So if every losing trade costs me 6 trades, then I have a net positive of 2 trades. And this is why it's so important to look at the combination of your take profit and stop loss in a meaningful way. I'm winning 2 trades on a consistent basis over my losses. Therefore, I'm going to profit exponentially over time in a compounded way. And that is what this table is really showing. But by taking and laying out the leverage in a meaningful way, I now have an apples to apples comparison for this asset versus Euro USD or any other asset on the market, so that I can see realistically that the duration of this market, 2 hours or 2 days, 14 hours, might as well just say 2 days, 15 hours. That is a representation of what I can expect to make over the course of that time frame, realistically in a way that gives me a potential. That potential shows me clearly where the stop loss is, the actual price I got into the market, and my actual take profit. And it shows my statistical approach to be 6 times more likely to profit over losing trades. And of course, the individual data shows the running balance as I accumulate over time. Again, showing the leverage. That is important, because when you get to a $175 loss, divide that by 20, you begin to see just how quickly things work both for and against you with a margined leveraged account. You also begin to see how long you hold a position. So you begin to see your average holding pattern based upon your stop losses and take profits. So as you begin to develop this information more consistently over time, you begin to see that, well, right here, this is 47 minutes. So what if I get out of the trade at 30 minutes no matter what? Is that going to be less losses? Potentially, yes. Again, that's where the data must be examined. Here's one. To take profit, or no, excuse me, this is a stop loss, but it took 2 hours. So we are already beginning to see a pattern where stop losses take longer than take profits. If that holds true over the course of the analysis, then we begin to build a reasonable expectation of how long we should wait before we get out of the trade and just take it no matter what. So let's keep going. Another stop loss at 21 minutes. You're not going to avoid every stop loss, but if you take a look at the tables, a whole run of take profits. Okay, another stop loss at 17 minutes. Another run of take profits. And you see 4 losses versus 34 winners. So the profits that were projected here were $337. Remember, that's leveraged. Divide by 20 to give you your rough estimate, which would be roughly $16. So $16 of profit for 2 days and 15 hours of trading if you chose this approach. That's not bad. Understanding the risk, understanding the reward, understanding the difference between the two in a meaningful way will give you meaningful profitability. So now let's take a look at what I ultimately am trying right now, which is double the risk for the reward. 5 pip take profit, 60 pip stop loss, because that seems to work well for the 10 seconds iteration that my bot is currently requiring. And as you can see, when you double your losses, they hurt. This is a projected $249 leveraged loss. That's painful. But nonetheless, you're looking at a 23-to-1 win to loss ratio. Now, my reward to risk ratio is 1-to-12. So for every 12 winning trades, I can expect 1 losing trade. So if I have 12 winning trades to 1 losing trade, well, that means 1 losing trade will wipe out 12 trades of profit. But I have a win to loss ratio of 23-to-1. So basically I am at 11 trades of profit above my break even. So by using this not so intuitive approach, I'm positioning myself in a way that I am more likely to profit over time because I am giving my trades room to breathe. And as you can see from the compounding, meaning you're seeing each unit over here, the units go up over time because the profits compound. So 2% of the balance every time I win or loss. The account grows slowly, consistently, and methodically. And that is the whole point of the process. And you can see the holding time that I could be expected. And again, you could draw a correlation between the amount of time and the stop loss, so that you could actually mitigate or lessen your losses over time by understanding when you should just close the position no matter what. For example, if this table shows a consistency of anything over 1 hour being a loss, then if you just get out of the trade after 1 hour, you're going to mitigate your losses more so than your profits. But you need to be aware that you're also going to kill any potential outline or take profits that might take longer to form. and they do happen, just not as consistent as the stop losses. But again, risk and reward have a correlation, and that correlation must be appropriate to your own trading abilities and style. So as you can see throughout this entire trade, I took one stop loss. It was a huge one, but nonetheless, it clearly shows that I have a reasonable expectation. And I even have knowledge here of how long a trade should last in order to be profitable. For example, none of my trades were held longer than 15 minutes. And that is 23 winners with 1 loser. Now, as we continue to look at other time frames, we will get an assessment of the appreciable extrapolation of data that we can then use to make even more informed decisions about our trading. So 379 leveraged profits, not bad for 2 days and 15 hours. Let's look at a higher time frame though. Let's look at what happens over time. So let's go to a common strategy is to use the 1 hour time frame. So let's unpack that and actually see where it takes us. Okay, now that we have it unpacked and we have all of the files that we can see, let's actually just look around. So let's look at the 530 like we looked at to begin with, but on the 1 hour. We see a reward to risk ratio of 0.17 to 1, but a win to loss ratio of 3.91 to 1. Not bad. Again, we see the fact that it is clearly margined, and that margining will play a role in the way this table looks. So profits and losses, the running balance, and most importantly, based upon the time frame, the number of holding hours. Now, this is important if you use applications like TradingView or any other kind of a charting software. You aren't going to get out of the trade instantaneously. But if you trade the 1 hour candle, your trades are going to take place in hourly intervals. A lot can go on in an hourly interval, so it's something to be concerned about as you trade and how that impacts your trading directly. But you see, realistically, here is an outliner, 12 hours for the stop loss. But it only lost, 3 hours. But 12 hours for the take profit. So a 3 hour stop loss and a 12 hour take profit. So you see how the outliners stand out in both cases. I personally will let it run all the way, no matter how long it takes. But nonetheless, if you're adverse to risk, for example, this particular stop loss is 12 hours. So if you get out before 12 hours, you also lose this profit. So this shows a direct correlation between what happens when you close early, both on your profits and on your losses. While you mitigate your losses, you also risk losing profits. But that might be a trade-off, because when you look at it, the profit was only $21, the loss was $166 by waiting. So there are some extreme and critical situations that need to be worked out in terms of evaluating your risk. Here's a particular take profit that took 2 days, but it only brought in $45. Whereas this particular one brought in $170 in 1 hour. So again, this is where this information, these tables correlate profit, loss, risk, reward in meaningful analysis, where you can make informed decisions about your trading appropriate to your own particular situation. So as we can see, let's get to the bottom of this, and we see that we have 1,625 winners, 416 losers. And it took us 293 days. Again, extrapolating the profits. Remember, this is margin. Take this number, divide by 20. And it's still pretty good. But nonetheless, something to be aware of as you extrapolate through each time frame to gain an understanding of the market you want to trade in. So let's actually look at the test case of where I'm actually testing this forward testing versus back testing. Okay, here is my forward testing log, where we can actually see the process step by step. Single position, buy, sell. And then, of course, the units appropriate to the leverage. Again, remember leverage. Everything in this is leveraged. Now, the balance is really worthless because it's a test account. And I do have other tests going on with different pairs. But the important part is the buying position at the price, the number of units. The selling position, whether or not I've made a profit or a loss, and you see directly and can begin to correlate exactly what that means in price value. And we will see that very shortly, where I actually run through the mathematics and demonstrate exactly what each trade did versus profit-loss combinations. So as you can see, this is roughly just shy of 24 hours of actual trading in a demo account. And you can see both profits and losses in a meaningful way. Now let's actually talk about the real world implications and numbers of examining a take profit versus a stop loss, where the take profit is lower than the stop loss. As you can see, the first trade was profitable, the second trade hurt, and it set the account down. If this was a $1,000 account, you're looking at about $976 balance. So that's really the goal of looking at the difference. Even though this has a 6-to-1 win to loss ratio, that loss is going to hurt. But over the course of time, it's going to be still profitable by 2 trades. It's not necessarily going to be a mechanism that you would want to trade long term for a particular situation unless you simply have a very good win to loss ratio. 5 pip take profit, 30 pip stop loss just doesn't have a high enough win to loss ratio. But a 5 pip take profit, 60 pip stop loss with an 11 trade win ratio over break even is exceptional enough that it's something you're going to want to use. But nonetheless, you see clearly how the winning trades work in relation to the losing trades when you consider using a smaller take profit versus stop loss. So by using a 5 to 60 combination, which is what I'm using now, I'm going to be 12 times more likely to profit than I am to loss. But when I do take a loss, that loss is going to be felt. But nonetheless, based upon the actual statistics, I'm going to have 11 wins above my break-even per each cycle. So that's realistic enough that it's worth the risk for my own personal trading. So as you examine this data and you look at the correlations between your take profit and your stop loss, and you weigh in the values appropriate to your balances in an unleveraged way, you will be able to make informed decisions about your trading such that as you trade, you get insight into the market and a way of being able to determine how long you want to hold your trades, what your trade's average time frame should be, and what happens when you have a condition where you're in a trade longer than you want to be. This is the kind of information all of this research is capable of doing and is capable of giving you with very little effort. So as we bring this discussion to a close, as you examine the data, look at the consequences of the winning to losing ratio in relation to your own personal trading. This is not a one-size-fits-all, but rather an approach that best fits your personal situation. And up until the 2-hour time frame, as you can see, most of the stop loss pips are 60 or below. So that means if you're not going to be holding a position for 2 hours or more, then realistically a stop loss of 60 pips or lower is going to give you a good combination, but only if your take profit is lower than your stop loss. As you can see from the table and the analysis, by examining every combination of take profit and stop loss, you gain the advantage by thinking about the market differently. Don't fall into the trap that your take profit has to be larger than your stop loss, because if it is, there's a good chance you're not giving the asset enough breathing room for price fluctuations, and you are more likely statistically to lose money than gain money. For example, a 2-to-1 reward to risk ratio. You are going to lose twice as many trades as you're going to win. That is exactly what that means. So you need to make sure your winning trades are going to overcome the losing trades. And as we've seen from these case studies, that doesn't happen often. And that's the point. At looking at sustainable trading in a long-term analysis, being able to figure out both short-term potential, for example, a reward to risk ratio where the reward is higher than the risk, works well if you're in a bull market. But if you're not specifically in a bull market, it's going to hurt you in the long term. And remember, bull markets or a bullish state is only going to be about 15% of the market. You still have to survive the other 85%. And this is how you do it. Now, you could only trade in that 15% of the market, but then you're missing out on 85% potential profitability that these tables demonstrate and show. So understand clearly how that plays in your trading as a critical component of determining how you trade, when you trade, and what your expected profitability should be given a very simple process. That process used in these experiments is very simply put. If I'm not in the market, I buy in at whatever the market price is. And then I hold the position until I either take profit or I get stopped out. This analysis is unbiased against the trading strategy because it is such a simple strategy that doesn't employ any real intelligence. So if these particular results show what they do with such a simple entry point into the market, then you can clearly see that any level of advanced analysis with proper risk management and proper budget management will legitimately profit over time in a consistent and reliable way. That is what all of this information really brings together in a meaningful context. The ability to profit with real-world data, both backtesting and forward testing, shows clearly how the market works in the long term. And I have been examining a myriad of different assets. I have data on all of these assets, and I will be adding more data as time goes on to different currencies. But because the markets change, I've taken the step of studying every time frame. Every single time frame, from 5 seconds to months, has been calculated. All of that data is here. For example, the daily time frame is 17 years of data on the market. So if you were to sit in the market for 17 years, you would have an expectation of market data. But the results are, from the daily time frame, you have an expectation of how the market moves. So it can help you develop shorter term thinking as well as what to look at and look for in longer term market volatility and survivability. So be sure to take a look at all of the data. Don't just settle on the one that brings in the most profits, because it's not appropriate. And as we can see here, the most profitable one here requires a 270 pip stop loss versus a 5 pip take profit. Realistically, the reward to risk ratio is extremely skewed, but what makes this stand out is the win to loss ratio. This is a context of long-term survivability and longevity in the market based upon what the market actually does. So you can see clearly and consistently a resilience of market data. That is what you want to look for in your own personal trading. And you can even see how over various numbers, if you want to survive long term on a daily chart, the stop loss must be big enough that your trade can breathe. Your trade can fluctuate within the market and not lose too much money too quickly. This isn't a matter of simply avoiding losses. It's a matter of understanding what those losses represent versus the potential profitability in relation to how much you profit over your losses. 31 losses for 1,753 profits is a significant win-to-loss ratio, and that is survivability and longevity. And 17 years of data isn't just bull markets, it's sideways markets, it's bear markets. It's a condition of longevity over a wide range of time. Understanding your situation in relation to this type of data is how you become successful in trading the market. The one thing that this does also highlight is the rhetoric of edge. Edge is your risk management. Edge is your budget management abilities. This just buys in the market with no thinking. So if you actually apply a real strategy, you are going to increase your chances of profitability. Your edge, though, is your ability to withstand and sustain a fluctuating market. Don't listen to the rhetoric that edge is strategy, because this proves over a wide course of analysis that edge is not dependent upon strategy. Edge is dependent upon understanding, correlating, and mitigating risk. So I'm going to wrap this up here. Please feel free to ask any questions. Leave them in the comments below. Remember, if you want access to all of this data, please sponsor this repository. Please sponsor Jackrabbit Relay. Thank you for watching, and until next time.